Another down day for the S&P 500, down about 76 basis points to $5,572.07 a share. If we look at the heat map, you can see here a little bit more green this time. Previously was all red across the board, but you can see semiconductors, a bit of green, consumer cyclical, Amazon, even Tesla's up a little bit. Obviously had some bad days, but a stock that drew my attention here, one of the ones that's been absolutely hammered today, is Verizon, ticker symbol VZ. So if we have a look here, obviously down 6.6% to $43.43 a share. But in the last 5 days, this had a bit of a big rally, up 10%. A lot of people moving their money into these stocks. I think one of the reasons people have bought this is this massive 6.24% dividend yield and potential of its undervalue with that P ratio of 10.5. But as you can see, had a big drop off today. So what we're going to be doing is looking at Verizon and then taking it to my automated stock valuation spreadsheet, looking at discounted free cash flow model, comparable company model, dividend discount model, and Ben Graham formula for intrinsic value. So firstly, we'll just put in the ticker here, VZ, and this will load up all the latest company financial data, and we can have a deeper dive. If you're interested, check my Patreon, links are in the description, but we'll continue here. So Verizon, $43 a share, 182 billion in market cap, a P ratio, as said before, of 10.5, which is a lot lower than the market average. It's decreasing 27.81, my mistake. But it's decreasing. Earnings per share $4.13 and a beta of 0.4, meaning it's a lot less volatile than the market. Target price, analysts say it's a buy at about $47 a share, so lower than its current price. Dividend yield, obviously this needs to be updated with the current price, but as we said before, you will get paid $2.53 a share, which is currently a 6.24% dividend yield. Is it a safe dividend? Yes, it is. They pay less than 11 billion, and in terms of the net income, it's about 60%, and in terms of the free cash flow payout ratio, it is 56%. So buy before the 10th of April if you want to get paid those dividends. So let's have a look at the revenue here. Very consistent revenue, although steadily growing, I suppose, since about 2020, down from its all-time highs of 22, which is 136.84 billion, but 134.8 billion. So increasing from 2023, which is good news. Net income, are they able to generate more profit out of that? The answer is currently no, 17.5 billion, up from 23 though, but you can see here not reaching the numbers of 21 and 22. Free cash flow, they do generate a lot of free cash flow, 18.92 billion. And if we look at operating cash flow versus capex, you can see capex is actually down, but operating cash flow is relatively flat. So operating cash flow minus capex is free cash flow. And obviously here, if they're spending less on capex, then the operating cash flow is flat, then the free cash flow is increasing. Shares outstanding, are they buying back their shares? You can see actually they are issuing more shares. Very small amounts, but yes, they are issuing more shares to raise capital. So let's have a look at the discounted free cash flow model. This is a way of valuing stocks, like their future free cash flows, discounting today's value. So currently giving us a price of $38.50 a share. Let's just have a look and we agree. We're expecting 136 and 137 billion in the coming years. Let's see. Okay, a little bit more bullish actually. And if we look at the growth, they're expecting about 4%. So let's just up this a little bit, say 2%. Puts us to 140. Net income margins, I think this is a fairer number, yeah. I mean, realistically, 13.5, I'm fine with that. Okay, here we go. So let's just go 73%, which was the lowest number in 23, puts us at $62 a share. If that was a bit higher, I mean, if they're able to keep it at 108%, their current one, it would be $92 a share. So discount free cash flow model does say this is a buy. Just before we continue, please check my Patreon. It's the $4 tier for the sheet. It gives you access to all the data, and you can do your own stock reviews as long as you're a paying member, as you'll get all the data and can do them as you please. Dividend discount model, let's have a quick look at this. They grow at just shy of 2%. So dividend discount model puts it about $76 a share. So discount free cash flow model says it's a buy, 62. Dividend discount model puts it as a buy. So let's have a look at the Ben Graham formula for intrinsic value. It looks at earnings per share, the P of a non-growth company, times the corporate bond yield, AAA bond yield, and currently corporate bond yield is 5.32, very high, and I think we saw that it was about 4% growth. I don't think Ben Graham's going to like this. He doesn't like a lot of stocks at the minute, poor Ben Graham, but let's put the number in and see what it says. 4.22. $43 a share. So as you can see here, puts it almost exactly where it's valued. Ideally, we want this bond yield down. You can see if it was 4%, it would be a massive buy, but once again, the bond yield is increasing. So Ben Graham puts it about fairly valued. Discount free cash flow model, sorry, puts it at undervalued, and the dividend discount model puts it at undervalued as well. So finally, let's have a look at the comparable company model. This is where valuing stocks, looking at their competitors, and we will put in, obviously, let's say one of their closest competitors is AT&T, major competitor in wireless and wireline, so hardline services. We'll do Comcast CMCSA. And we'll also do, I'll put it in a second actually, we'll switch the order on. We'll go T-Moose, which is T-Mobile, and CSCA. Okay, so let's have a look here. We're looking at enterprise value, revenue growth rates, EBITDA, net income, profit margins. We have price to sales, price to book, and PEG. And then the specific metrics are EV to revenue, EV to EBITDA, PE, and forward PE. So in terms of enterprise value, T-Mobile is the biggest, then Verizon, then AT&T, and Comcast. Revenue, Verizon actually has the highest. Third lowest revenue growth rate is relatively flat, AT&T and down. T-Mobile is up 13%, quite good, and Comcast 2.8. EBITDA highest, most profitable, sort of, well, I'll put them joint second place margins. You can see they're all above about 10% or 12%, sorry, apart from AT&T. Price to sales, market average is around about 2.85. All of these below that apart from T-Mobile, which is good. Price to book, I think the market average is 4.8. You can see once again all of these lower, T-Mobile in about the middle of the pack. PEG, Peter Lynch's price to earnings growth. You ideally want this under 1, none of them are, and this is about 3. But the specific metrics we're looking at here, EV to revenue, middle of the pack towards the bottom, EV to EBITDA, second lowest, PE, second lowest, forward PE, second lowest. So all buys according to this, $66 a share. So Ben Graham price puts it about fairly valued. Dividend discount model puts it somewhere in the region of $70. Comparable company model puts it at 66. And finally, the discounted free cash flow model puts it at 62. So we just quickly look at the stock again. We go over the last year, you can see it's had pretty wild swings. It was trading about $38 a share not too long ago. If we go on the last 5 years, you can see the stock has been hammered. It was previously trading at $60 a share. It lows of 30 and it's about 40% since then. But as I said before, one of the reasons people like this and probably throwing money in now is the massive dividend yield, which obviously a lot of people enjoy. And as I said before, if you want to get paid the dividend, please buy before the 10th of April and you'll get paid your quarterly dividend. Right guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon and I'll catch you guys next time.